Well, welcome everyone to our Spotlight Series live podcast. It's the 8th of December 2020. I'm Andy Macken, Chief Investment Officer. And with me today is my co-portfolio manager, Chris Demasi. Chris, how's it going?
Good, how are you?
Yeah, not too bad. You ready for this year to end?
Ready for it to end. I was just thinking before we came on, we've gone from a tough earnings season into the cricket season, going headlong into silly season. And I think we're all ready for it.
I think we are. And actually, speaking of cricket, we've actually got a special guest today dialing in via Zoom from New York, and that's our senior analyst, Amit Nath. Amit, can you hear us?
Hi, guys. I can. Very well. It's a little bit cooler over here than it is in Sydney, and I am missing the cricket. So thanks for rubbing that one in.
Yeah, and actually, we'll miss you tonight. The Montica team are actually having a little bit of a team outing at the Australia-India T20 at the SCG. So
I won't miss him too much. Amit tells us, for everyone out there, Amit tells us that he's an Australian supporter until India plays Australia, and then he's an Indian supporter. So I can do without hearing Amit in the stands tonight.
Yeah, that sounds about right. Okay. Okay. Well, thank you for connecting in, Amit, on your evening. I really appreciate it. Look, just to recap the purpose of the Spotlight series, and it's really all about connecting with our clients and sharing our views on topics that we think are relevant to you, and hopefully that you find interesting. There's no marketing, no scripting, just a live discussion about things that we think are interesting and insightful for your investing. So the structure of today, as usual, there'll be 3 segments. The first segment, we'll talk about something directly from the Montica investment team. And today we're going to have a discussion about the cloud, which is, of course, a word or really a technology concept that is being thrown around a lot and will continue to be thrown around for the foreseeable future, because it is a concept which is increasingly applicable to just about every company on planet Earth. We'll then go into part 2, which is talking about something that we're seeing in the press that we think might be interesting and topical to address. And so today we'll have a discussion about some of the regulatory noise in the Chinese fintech space. And then finally, of course, we'll answer a handful of questions that you've sent in over the last few weeks. So with that, let's get going. The cloud, I think maybe just to begin, why don't we get Amit to try to define for us just what the cloud is. And I will say, for those who don't know, fun fact about Amit and I actually studied electrical engineering together 20 years ago. So I don't know if that brings more credibility to the conversation. It probably doesn't. In fact, all it probably does is increase the risk that we start spewing out unintelligible jargon. So we'll try to keep everybody honest and just talk in understandable English. So Amit, how would you define what the cloud actually is?
Yeah, thanks, Andy. It's a good question. I think if you ask 10 people, you'll probably get 10 different answers. But I think at kind of its most basic, despite our electrical engineering background, we like to keep things pretty basic. But at its most basic, and kind of relatably, if you sort of think about as consumers, as we all are, you can either buy something or you can rent it. So large big ticket items in our lives, maybe a car or a house, you might rent it or you might buy it. So interestingly now, like in the modern world, big companies have the same choice, but it's with their computing resources and network, and pretty much everything you need to do on a computer you can now rent. There's a number of benefits which we'll probably cover in a little bit, but in terms of the actual cloud, it's effectively, if you think about it as a giant computer in the sky, and then so that's kind of like what the cloud is at the most basic level. And then within the cloud, it's sort of broken into 3 pieces. The first piece is infrastructure. So we'll refer to that as the infrastructure layer, which is the most commoditized piece of it all. Then above that is the platform layer, which is it has a little bit more software than the infrastructure layer, which is predominantly all hardware. and then you have the application layer the application layer, which has pretty much all the software. So they're the three kind of layers within the cloud.
So Amit, if we take a step back, so previously companies all around the world would say, okay, I need some computing infrastructure. So I'll go out and I'll buy servers and I'll buy my physical infrastructure. And for each of my employees, I'll probably have one of those big box desktops sitting under their desk. And each employee will have their own memory, their own processor, their own applications, which they download. And then essentially their applications will all be run kind of locally on their own machine. Mm-hmm. And what we're saying is that the new way of doing things in the cloud is to actually kind of outsource the infrastructure, outsource the applications, and then the companies can kind of draw on those resources as and when they need to.
Yeah, totally. It's almost like having a taxi service on demand. So just so you need to go somewhere, you sort of call up the Uber, and the Uber will arrive at your door and take you to wherever you like. And so just like you said, as a company, if you need some more sort of storage, or if you need some more bandwidth, just so everyone's watching the cricket one night in the office, well, you might need a lot more bandwidth. So yeah, it can just all be pulled down, very kind of on-demand style. And I guess the added benefit is you don't have the depreciation of those resources. So computing resources go out of date pretty quickly. So
yeah, so let's just before we come to the benefits from the perspective of customers, because I want to address that as well as from the perspective of software vendors as well. But just to go into those three layers you described, so infrastructure, platform, and then the application layer on the top. I guess from my perspective, this is, I think, one of the most interesting kind of dynamics as to how this space has evolved, because the concept of outsourcing is pretty straightforward. I mean, every company doesn't go and buy their own airplane to fly their staff around, right? Like we share commercial airlines, not so much this year, but usually that's what we do. It's shared resources. That's a simple enough concept. But it's actually more than that, because then the shared resources have been, essentially separated into multiple layers of abstraction. What does that mean? That means, you've got three different layers that are sort of independent from each other, and especially when developers are making applications, you don't actually need to worry about what's now beneath it. You can make an application that is independent of the platform layer and the infrastructure layer. Said another way, I guess those who are providing these outsourced resources can specialize just in infrastructure, so memory, storage, and then businesses that specialize in platform, which is things like databases, operating systems, and then those who specialize just in the development of applications. They can all kind of just focus on what they're good at and know that the different layers will talk to each other and are independent from each other, which is a really intelligent way to organize this new form of doing things.
Well, it's win-win as well. So what we've come to learn, and I haven't had the benefit of studying this as long as the two of my esteemed colleagues on the line.
As long ago, you mean, yeah.
But what we have come to learn is that there are great benefits here for the customers, but also for the vendors themselves. So for the computing companies that actually sell the infrastructure and the platform and the applications, but they're doing it out of the cloud now rather than selling it to you to put underneath our desks in the office.
Yeah, so this is a big idea. So let's explore this idea that it is truly a win-win between both the customers and the software vendors. So Chris, maybe let's talk about some of the benefits from the customer's perspective. So why do corporates out there really care about wanting to shift to the cloud?
We've touched on it. The first place I'd start is that customers, whether it's small businesses like our own, big companies, they don't have the same upfront costs anymore. So they don't have to go and spend hundreds of thousands or millions of dollars on that initial setup, which means going out and buying big data centers and servers, and then on top of that, actually installing all of the software that they'll need. So those upfront fixed costs go away. With time, as they outsource the platform software and the application software, the maintenance costs also go away because the vendor deals with that. So it's a much more flexible and efficient model to really get going, get started, and then to extend your capabilities as that enterprise customer that's consuming all the computing resources from the infrastructure layer all the way up to the software layer.
So that issue around flexibility, I think, is a really big deal, and scalability, because you might be a growing business, and so the resources that you need today are much less than what you'll need in the future. But in the old world, you had to kind of anticipate what you were going to need in the future and make big upfront capital investments and implementation investments. And whereas today in the cloud, you just pay for what you use, and then you use as much or as little as you need. And you can scale up and you can scale down, and it's very, very user friendly for businesses.
Yeah, absolutely.
The other really good thing for the customers is the versioning. So, we've all kind of, back in yesteryear, we'd all, have to upgrade our, desktop software. There'd have to be an outage. The IT department would have to come in and it's a laborious task. In fact, it's so laborious that a lot of companies don't even do it because, the outage and sort of the downtime. And so the benefit of the cloud is, pretty much, as frequently as they like, for the customer, the cloud will update and the customer will always be running the latest version. And so there's a few benefits of this, not just because you get the latest and greatest from what you're paying for, but also because in this world of security and hacking, it actually provides a much more secure set of applications and a computing environment for a customer as well.
Yeah, that's true. And security today is probably the number one priority for CTOs and CIOs out there. So there's some benefits from the customer perspective. If we then sort of exploring this win-win concept, so from the vendor's perspective, and maybe first I'll start with Amit and say, put your developer's hat on. In a prior life, you have been developing code. How does this cloud construct make it easier for developers to create new applications?
So it's when you're building an application, you can obviously, I think we've touched on, as we said, the win-win, the win-win construct. A lot of the benefits for the vendor are actually similar to the benefits for the customer. So as a developer, the ability to have unlimited compute resources, having a consistent, well-known environment, that makes things a lot easier versus having to go into an individual company. So just say you're a developer for some of the bigger well-known clouds are Azure from Microsoft, AWS from Amazon. If you're a developer and you're very familiar with these environments already, if a customer comes to you and says we need to we need to solve this problem, the developer pretty much can start on that immediately without having to go in and do a rigorous analysis of what is already deployed at the customer side. So I guess it just reduces friction costs from the developer.
So said another way, the developer basically doesn't have to go and reinvent the wheel, right? They can just focus on the problem that's being asked. They don't have to worry about, oh my God, which operating system are you using? What database are you using? How much memory do you have? All of that is just kind of taken care of by the platform layer and the infrastructure layer. And I guess through that lens, and actually this is one of the ways that was described to us many years ago when we were investigating this to begin with. these platform layers offered by Amazon and Microsoft are basically like a gigantic Swiss Army knife for developers. And whether it relates to security or AI, they can just kind of call on these different libraries and have them implemented in their applications, rather than having to go and sort of build those up from first principles each and every time they want to build a new application. So it's clear. I mean, this is the ship has sailed. It is the way forward from the perspective of developers. From a financial perspective, Chris, from the perspective of a software vendor, let's talk about some of the reasons why this revenue model is superior for that vendor.
Yeah, I think the overall business model's
the business model
superior. And that's despite having to wear all of those upfront costs that your customers aren't paying for anymore. So, so the cloud computing vendors typically pay for all of these upfront costs. They pay for the data centers, they pay for the servers, the computers, the storage, the networking that goes in there. Once they've paid for all those fixed costs up front, they then have the benefit of very low additional or marginal costs as they fill up the space. And so they're able to leverage that scale and the low incremental costs in their business. There's a couple of other cost advantages as well, as I think of them. As a large scale cloud computing provider, some of the large companies that Amit just mentioned, so the Amazons of the world, the Microsofts of the world, even Google has a very large cloud computing platform. They're able to go back to the vendors of the servers, of the storage and the equipment, and they're able to lower their costs, which they then share with the customers, but they pocket for themselves as well. And we've seen some other cost advantages. Some of the ones that maybe Amit, you might want to dig deeper on, but I'll introduce are around sales and marketing intensity. So we've found that cloud companies don't have to spend so much money to win that next sale because they own their customer and they're in front of their customer, updating their products and speaking with them on a regular basis. And so we've found that cloud companies are able to generate these efficiencies in their own business and lower their cost of providing computing to their customers.
Oh, sorry, Amit, you go ahead.
I was just going to follow on from Chris. Yeah, it's a really good point. Like particularly like the stickiness of the ability to sell more products. Once you've kind of got that relationship with a vendor, AWS or Azure, etc. And you've got one piece of software from them, most notably probably Office. A lot of us use Office day to day. When you've kind of got that at your company and you're kind of familiar with it, Microsoft is very easy. It's very easy for Microsoft to come and say, well, what about a bit more security, or how about we upgrade you from a operating system perspective, and so it kind of snowballs from there. Once you kind of and because it's so easy to add on, it's not like this goes back to the platform economics and the infrastructure economics. It's not like having to re-provision massive amounts of compute and bandwidth and licensing. It's all very, very seamless. Like the customer not only can the customer draw down resources from the cloud on demand, they can actually scale their business on demand as well. So you can actually get infrastructure into your business very, very quickly as well.
So we've talked about Microsoft a lot in this discussion. We've talked about Amazon a lot in this discussion. Why are we talking about those two names?
We're talking about them because they are the dominant providers of the public cloud, as we describe the infrastructure layer and the platform layer. Together, those two layers of the cloud represent more than $1 trillion in value. Microsoft's Azure cloud platform and Amazon's AWS cloud platform together are the leaders in that space. Amazon more so in the infrastructure space, and Azure, Microsoft's Azure more on the platform software side of the business. But they are the clear leaders in a marketplace that is going from, less than $100 billion today, still a massive marketplace, but it's going to continue growing at 30, 40% or more to become $1 trillion market in our lifetimes.
Yeah, and it's pretty extraordinary to think about. So we've articulated the dynamic that has been taking place and will take place for the next decade and beyond in terms of the shift from on-premise infrastructure to off-premise infrastructure and applications being developed off-premise, and as well as existing on-premise applications being sort of transformed or evolved across to become more cloud-native applications. Microsoft CEO Satya Nadella thinks that we're only about a fifth of the way through that process, which is just extraordinary. So there's a very long way to go, and it's extraordinary to think that the entire world, perhaps ex-China, we'll come back to China has its own kind of more ring-fenced market, but the whole world ex-China's software applications are essentially going to be housed on a platform owned by Microsoft and Amazon.
Yeah, it's going to be one or the other. And, you go back in time and Amazon really got the jump on everybody. They were using so much square footage of data centers and servers for their own internal operations. And they were able to then to lease some of that out to enterprises, to internet companies who run their applications off Amazon Web Services servers. I think it took a little bit longer for Microsoft to get there, but the benefit that Microsoft had, and Amit's really close to Microsoft, is that they owned the customer relationship and they had a massive install base, which they were then able to go to and together with that install base, build out their Azure platform. So 70% of the world's servers were already running Microsoft Windows. Yeah. And as enterprise customers were looking to move to the cloud, it was natural and an easy sell for Microsoft to be able to do that with them and provide their platform software like Windows and like SQL database in the cloud and call it Azure.
Yeah. So I guess our audience will not be surprised to learn that we do own both Amazon and Microsoft in our portfolios, and while perhaps fewer points for originality there, these businesses are just too extraordinary to not include in one's portfolio, given the extraordinary runway that lies ahead for the next decade and beyond. So why don't we park that discussion? Anything else you want to say about the cloud before we move on, or should we continue on?
Yeah, I guess one thing that kind of just the final thing I have to say on this would be the economies of scale and the ability for these three, effectively two or three major cloud providers to kind of provide these resources has more than just economic benefit. It actually enables them to become net carbon neutral. And so with this, with the economies of scale and the ability to have hydro resources and wind resources that are powering, these giant data centers, but rather than having it all dispersed across, different companies, Microsoft has actually pledged that by 2030 it will be net carbon positive. So it won't net carbon negative. So, and that goes back to its founding back in 20, 30 plus years ago. And so, yeah, it's kind of like an environmental positive as well. So both for customers, vendors, and also the environment. So the cloud is it is actually quite a very positive piece of infrastructure.
It's a win-win-win.
It's a win-win-win.
I hadn't fully appreciated.
Very good. Thank you, Amit. Okay, so let's continue on. Something from the press now, part 2 of our Spotlight series podcast. What we thought we'd do is address some of the noise coming out of China with respect to the new potential regulations in its fintech space. And of course, many of you will know that in early November, the impending IPO of Ant Group was suspended, and now it's not looking like it will happen until 2022, in fact. This is going to be the world's largest IPO at around $40 billion. They were not having any trouble raising that capital, because I think there were more than $3 trillion of bids from Chinese retail investors. So this was a really big deal, and it was pretty newsworthy, to say the least, that the IPO was suspended. So why don't we start there, Chris? We did, of course, take a look at Ant Group and consider whether or not to bid on it in its IPO before it got shelved. For those who are interested, we actually chose not to do that. So Chris, why don't you give a brief summary of the Ant business and why we chose to exclude it, and then we can talk about some of the new regulations which are maybe layered on by Chinese regulators.
Absolutely. So notwithstanding the competition, $3 trillion worth of competition we would have had in getting an allocation in that IPO, we did have a look at the company. And the reason we had a look at it is because it's an exciting company, and it's in a very fast growing space in China in the digital payments and financial technology space. There's two parts to the Ant business. On one hand, you have Alipay, which is the largest digital payments provider in China. And that market is a 200 trillion renminbi market, divided by 7 if you want dollars in that case. So it's a $30 trillion market. And it's a two-horse race that Alipay leads with a 55% market share. The rest of the market is tied up by another large internet company, Tencent's Tenpay offering. And that marketplace is set to double over the next 5 years. So there's some really attractive and exciting attributes to that marketplace. And Alipay makes its money by taking a very small clip or share of all of the transactions that are processed over its platform. At the end of the day, though, it doesn't make very much money at all from doing that.
And that's, I think, hasn't really been talked about nearly enough. You know, you've got a 200 trillion renminbi or $70 trillion US market, and you've got a 55% market share. You would think, how can you not make money? And yet this thing really doesn't make any money. So
doesn't make some would call it free parking, and they use it to try and feed the other side of their business,
right,
which is their financial technology business, and primarily what they're doing on that side of the business is originating consumer and small medium business loans online. And they're partnering up with banks, regional banks, city banks, some of the smaller banks in China to fund those loans. And again, similar to what they're doing in Alipay and their payments business, they're taking a small slice of that loan and pocketing that, and that's where they're making some profits.
So they're essentially acting as a customer acquisition kind of platform for banks.
Absolutely.
And so they'll leverage their data to try to assess, which customers are the best borrowers and size them up, and then essentially do all the heavy lifting, and then just farm off the loan to the bank.
And that's the attraction for the banks. It's a very easy way for the banks to access 1 billion customers. There's 500 million different consumers have received loans through that platform, through Ant Group's platform. So it's a great way for banks to access that distribution, and it's also a great way for them to harness the data that Alipay brings, not just their own data around consumers and the payments that they're making and their credit history, but they also have an agreement with Alibaba and the e-commerce business, the largest e-commerce business in China,
which owns a third of Ant Group. So
which also itself owns
there's
a relationship. Business. There's a really strong relationship there, but between the distribution and the data, it's a really attractive combination for the banks to partner up with Ant Group to originate these loans, get access to the customer base, and Ant gets to take a small slice of that on the way through. So that's how they're monetizing.
Okay, so there's probably a few members of the audience sitting here right now saying, "Well, that all sounds pretty good." So, so what's the problem?
Well, it is all really good, but we also identified a few concerns in there. Now, I'd say commercially, one of the key concerns that we had is the way in which they monetize this business is to take that small percentage of the loans that they write with the partner banks. And on our analysis,
so a percentage of, are you saying a percentage of the spread that they can charge?
So and look, so this where does this end up coming to bear is that the banks charge an interest rate.
Yep.
They have to pay for their funding. There's a small spread.
So there's a profit sort of spread. That's
Absolutely.
how the banks make their money. Yeah.
And Ant Group takes a share of that.
A piece of that. Okay.
The problem is the problem for them, and it's a nice problem to have, is they've already taken a considerable share of that spread. So there's very little.
Right. So how much can that expand? Probably not as much as.
And that was a question for us. Right. So we had a question mark over that. And as time goes on and growth in volume start to moderate, there wouldn't be any growth in what the business could end up charging its banking partners. So that was a key concern for us on the commercial side of the investment thesis. It also wasn't obviously cheap to us.
Yeah.
Okay, this is a business that at the proposed IPO price was going to be worth over $300 billion, which is more than most banks in China and the United States today. So it wasn't an obvious bargain.
Yeah.
But then more importantly, I think where we had our greatest concerns was on the regulatory front. So there's potential for the market regulator to open up access to other players, to other payments providers, other fintech providers that would create more competition, more pricing pressure, and potentially a loss of market share in time. But I think the biggest regulatory risk that we were worried about came in the form of Ant Group having to co-fund the loans that they were originating with their banking partners.
And this is exactly the noise that has come out of China just in the last few weeks, and is the specific reason why the Ant IPO had to be suspended. Because of course, if Ant all of a sudden now needs to hold capital against all of these loans, or some of these loans on their balance sheet, then the value of that business's equity is materially lower than it was yesterday when they didn't have to hold any capital.
And the proposed regulation is that Ant now might be looking at having to fund 30% of the loans that they originate, so 30 cents in each dollar of every loan. They probably have to set aside some capital, or at least some level of loan loss reserves, in case any of those loans go bad. And so far they haven't had to do that. So they've been able to grow in what we'd say is a capital light manner, not having to set aside any shareholder funds to support the tremendous growth that they've had. But that all might be about to change. And it changes the profitability of the business, it changes the returns, and it also moderates the growth profile.
So with the stroke of a pen, and that's if the stroke of this pen does actually happen, because nothing has been formalized. There's just a lot of noise and suggestions. But with the stroke of a pen, should that happen, the value of Ant becomes materially impaired compared to where most of those investors thought the value of Ant would be. So look, that's a really big deal, we think, and something that investors should be aware of. I would say more generally, our view of the technology space in China and with respect to its interaction with much of the rest of the world is that it will continue to decouple along this dimension of technology. Without going into each issue specifically, we do know that Huawei has been banned from many countries' 5G networks. We know that TikTok has been banned in India. I'm assuming you've still got family back in India. TikTok's
Yeah,
not allowed, including a number of other Chinese apps.
yeah, it was a big deal. I think TikTok had over 100 million users in India when it got banned. So it was a bit of a shock. And then I think another 200 apps were also taken down, Chinese origin in the country.
So even in the US, there's talk of TikTok being potentially banned in the future. Even WeChat, there was talk of it being banned. We know that here in Australia, Prime Minister Scott Morrison was censored on WeChat just a few weeks ago. So that raises questions: will the Australian government take action against any Chinese apps? So, and then of course on the Chinese side, it probably goes without saying that many of the apps that are loved outside of China are already banned in China. So whether it's Facebook or LinkedIn or Twitter, all of those are blocked in China. So if you take a step back, you would have to suspect that a world in which there's kind of a Chinese ecosystem and an ex-Chinese ecosystem from a technology perspective is something that's very possible. And through that lens, that's why from an investment perspective, we definitely favour those businesses who are in one camp or the other. You know, Microsoft, Amazon, Facebook are all in sort of dominating the world ex-China, and then businesses like Tencent and Alibaba do derive substantially all of their revenues, or certainly most of their revenues, from the Chinese mainland. And we would be more concerned about technology businesses that had significant cross-border transactions in that respect. So we'll leave it there for that topic of what's happening in the Chinese regulatory space with respect to technology. And we might now just jump to a couple of questions to round out this podcast. Conscious of time, but we did receive a couple, so I want to get to those. And of course, if anybody would like to ask a question anytime, just email question@montica.com. Any question, any topic, it's no problem. The first question I might pass to Amit, since we have you. Our first question comes from Lawrence, and it relates to our position in Vivendi. And Lawrence asks, why is Vivendi such a large holding in your portfolio today?
Thanks, Lawrence. Good question. I might just start with what Vivendi is. Vivendi, it's a conglomerate, but really it is its largest asset is Universal Music Group, which is the largest record label in the world. They have significant market share of all recorded music. At the moment, we're in another secular transition. As we talked about with cloud, we're actually seeing this at the consumer side with music streaming, and so Vivendi is going to benefit, or is benefiting very, very materially by this streaming transition. And as that happens, the margin that's released from the streaming revenues is extremely high, because if you can imagine, a lot of the music that has been written, the cost has already been amortized, and so now with streaming, people are revisiting their good time oldies and going back to music that they'd listened to in yesteryear. In fact, 2/3 of all music that's streamed is actually back catalog music, and that's the very, very high margin music. And so Vivendi actually has a claim through UMG on all streaming services, not just Spotify or Apple Music or Peloton. Wherever you hear music being played, Vivendi and Universal Music will share in those economics. And in terms of why it's so big, I think it's we think it's very, very undervalued. We think there's substantial appreciation that the market isn't currently ascribing to it. The recent IPO of Warner Music Group would imply a very material re-rating for the stock. And I guess second reason is just there's not too much downside. We don't perceive there to be a lot of downside there. In fact, the company has a very significant share buyback program at effectively the current share price. So we have a few obviously there's a few reasons for why it is our largest position, or one of our larger positions.
Yeah, I think that's right, and it's sometimes counterintuitive that you always think that the names at the top of the list in terms of your top 10 holdings are the ones that have the most upside. And it's not necessarily the case. They're actually often the ones that have the least downside. And so certainly Vivendi fits that category in our view. Okay, thanks, Amit. And then our second question I'll pass to Chris, and this is from Gareth. And Gareth asks a two-part question, Chris, to keep you on your toes. The first part is, what do you believe the likelihood is of regulators either in the US or the EU coming down on Google, given its monopolistic position in search? And then Gareth sort of opines that, regulation always seems like a bit of a headwind that never really causes much damage to the share price. So how do you think about that?
Well, I think regulation is always tricky. And the reason, Gareth, I think regulation is always tricky is because you've got to handicap a few different elements here. So you've got to think about the probability of additional regulation coming into the space. We've got to think about what the shape of that regulation might be. And then thirdly, you've got to think of the potential impact on the business, on the business operations. And that's before you come to thinking about any of the potential mitigants there. As it relates to Google, I think it's one thing to assert that Google has a monopoly, which they do in search. It's effectively 100% market share in internet search. But the second element to any regulation around that monopoly is whether or not it's harmful to consumers. And,
right.
And I think this is the sticking point for regulators and where it's always going to be difficult for them.
Especially for Google, specifically.
Absolutely, specifically to Google, because their service, not only is it so helpful and so valuable, but they give it away. It's free.
Yeah.
And it's tremendously valuable, and we know that. And I'm glad that we've got Amit with us, because Amit was describing to us a survey that was done, which really highlighted just how valuable consumers believe Google to be in their lives. And Amit, you had a number for us, right?
It was really interesting. Yeah, it was like, I think, an MIT survey with 80,000 people, and they found that the average consumer would need $1,500 per month to give up Google search, and another $300 per month to give up Google Maps. So it's $1,800 per month of value.
Which you could flip on its head, and you could say, hypothetically, if Google decided to switch off its advertising and just go to a subscription business, then it could charge $1,800 per month just for search and maps,
which is really amazing. And it's orders of magnitude greater than the value of Google today.
That's right. So it's in the extreme scenario where somehow advertising was banned, which we just do not see. It could actually be very good for Google because they would have other ways to monetize.
So look, I think we're always going to be speaking about this balancing act that Google has to play with regulators, because Google is such a large company. The revenue of this business is $200 billion. It's a worldwide company, and it's intertwined in all of our lives all the time. So there's always going to be toing and froing between the company and their regulators. But I think what we're more likely to see is the two working hand in glove, and it's not always going to be as friendly as what we might want, but there's always going to be some gives and some takes there. But I think it's very unlikely that there are onerous regulations that come down on Google and their business model, just given how much value they give away to the consumer and how consumer friendly their business really is.
Okay, thank you very much. Look, we're going to leave it there. Amit, thank you very much for connecting in to us on your cold night. I did actually check the old iPhone beforehand. It's 3 degrees Celsius over in New York at the moment. A little bit different from the sunny 25 degrees in Sydney here. So sorry to make you a little bit jealous.
Yes.
But thank you very much for connecting in, and we'll do it again. Chris, thank you very much. Have a good holiday. Try to take some time off, and we will come back and do a spotlight series fairly early on in the new year.
Absolutely.
And to everyone at home, thank you very much for joining, and we certainly do wish you a very safe and happy year-end holiday period. As always, if you'd like to get in touch, question@montega.com, either questions or feedback, we'd love to hear from you. Thank you.
Thank you.